Right, guys. Okay, good. So welcome to our fifth session. Right, so as I mentioned, today we are going to look at stocks, which is mainly equity, right? And we'll look at how to value equity. So the plan for today is as follows. So we talked about the purpose of capital markets when we started talking about long-term debt, and when we so in the previous session we talked about bonds, and we mainly looked at long-term bonds and how to value them. So it will be just a quick refresher of the purpose of capital markets, but from the perspective of equity. Then we'll look at the characteristics of equity and how is it different from debt. We'll talk about the primary and secondary market for equity securities. And later on, we'll look at how equity securities are issued in the market. So what are the primary markets and what are the secondary markets, how stocks are issued. We'll look at the process. We'll talk about IPOs and the IPO process as well. And then we'll spend some time on equity valuation. Lastly, I would probably highlight, if there's some time left, I'll probably highlight some of the errors that we could make while valuing equity. Okay. Good. So just to put everything in context, so here is an example for you. So in August 2004, so that's when Google went public. Okay, so it offered its shares in an unusual IPO format. Shares were originally offered at a price of $85 per share. And when the shares closed, the closing price of shares at the end of the first trading day was $100. So that's in 2004. At the end of 2012, these shares were trading on NASDAQ, which is one of the stock exchanges, at $707 per share. Okay. So how many years does it make from 2004 to 2012? 8 years. Okay. Good, 8 years. And you can see the change in price from $85 to $707. Okay. So what I've done here is, if you, for example, quickly look at okay, you should do it on your own devices. So if you quickly look at the price of Google now, what does it show you?
$96 US.
96 US dollars, right? And because there's a lot of time between 2012 and now we're in 2022, so part of the variation could be explained by the changes in price over this time. But if you look at the difference, right? In 2012, it was 707. Now it's like close to 100, right? So that's a very big difference. One way, I mean, one conclusion that you could probably draw is that, stock prices might have fallen during these 12 years, 10, 12 years, right? Okay. Another reason that, the stock prices could change is if the company does a stock split. Okay, what is a stock split? What is a stock split? When a company splits the value of its share into multiple shares. So one share is divided into multiple shares. That's what we stock split. So I've just listed this down for you. So the issue price. So after adjusting for any stock splits that happened during this period, the issuing price turns out to be close to 2.71. Okay. So it did a 2-for-1 split in 2014, which means for every one share that a person holds, now the person will get 2 shares. So theoretically, there should be no change in value. Okay, so let's say a stock is valued at £100 or $100, right? And if the company does a 2-for-1 split, what would be the new value per share? Theoretically, it should be 50, right? It should be 50. Right? Does it make sense? Right? Because it's exactly the same company, exactly the same share. All you have done is you have broken the share down into 2 parts, right? Okay. But in reality, in practice, the new value can be slightly higher than 50. Okay. Can you think of any potential reason for the slightly higher value? Although it's exactly the same company, right? Exactly the same share, but you just split it into 2. Can you think of any reason? Yeah.
Increase the number of shares for the investors.
Yeah, of course, the number of shares would go up, right? But what's the reason for slight increase in value? It should be $50, right? Yes. But if I say the share is trading at 50.5 or 51, how can you explain that? So you're right, the number of shares go up, right? So if there are more number of shares, what difference does it make? Firstly, sorry, supply has increased, so there are greater number of shares outstanding. Okay. But also the price is up, right? Okay. So the depth of the market can increase. Now, people who have, fewer savings, they can also participate, right? So the liquidity can potentially go up. Okay. So the base, the market has widened for this share, right? So not everybody can buy a share for, let's say, £100. But if it's like 2-for-1, so if it's like now price at 50, more people can potentially be willing to invest in the stock at lower price. So it did a 2-for-1 split in 2014, and then it did a 20-for-1 in 2022. Right. Okay.
Sorry, question.
Yeah.
So I thought the question was why it can be more than 50 instead of, as in when you split it, or let's say you have 100, I thought the question you asked was why it can be like 50.5.
Yeah. So because there is increase in liquidity, right? The demand for the shares would go up. There are greater number of potential buyers.
Okay.
That increase the price.
Thank you.
In US, investors buy fractional shares.
Yeah. No, you can't buy fractional shares. You have to buy a share. It's not like you can buy 1.5 share, right? You have to buy the whole share. Okay, good. Right, so what I want you to do right now is to calculate the annualized return. This is something that you should be able to do because that's what we have done and covered in the past few weeks. So what I want you to do is to say, let's say you take this price, 2.71, and this is the price in August 2021, 144. Okay, so these prices are after adjusting for stock splits. Okay, so can you calculate the annualized return for Google over this period? Okay, all you have to, the hint for you is all you have to do is to apply the present value and the future value formula, right? The relationship between present value and the future value. Okay, so you now, so what is the future value here? The value in 2012, sorry, 2021, right? August 2021. And then we have the initial price. Okay, which is 2.71. And you can calculate the number of years in between. Okay. What's the number of years between 2004 and 2021? 17. Okay. Okay. You should be able to do it, right? Okay, what is future value? Future value is equal to present value times 1 plus r to the power n, right? Okay, so you have to calculate this r. You have the future value, you have the present value, you have the number of years. Okay, good. What's happening? Anyone got the answer? What's the return? Okay. Has anyone got the answer? No? Why? 26.4? 26.4, good, good. That- You got it? Yeah, why not?
6 point.
I didn't want to. That one's really fun.
Did you want to wait for the answer? The exam as well? Yes. All right, yes. Yeah, that's fine, yeah. Okay, so it's around 26%, right? 26.4%. Okay, good, 26.4%. What do you think about this return? Is it a good return? Less? 5? 5, 10? Okay, good, very good. Okay, good. So for example, if you had like, you know, $2.71 back in 2004, and you had invested that, and you had bought Google stock, now you would have been worth, not that one stock would have been worth $144. And if you had like spent the same amount in thousands, right? So you can imagine how much money would you have made. So this annualized return at 26.4% means every year Google generated a return of 26.4%. It doesn't mean that every single year Google generated 26.4%. All it means that it's an average return. In some years, it might have generated, let's say, 12%. It could be, you know, in one of the years, let's say, minus 12% or minus 6%. Another year, it could be like 36% or 32%, right? So this average return is the average of all, you know, this period. But that's a really good return, right? Okay. What do you think about, okay, so this is just part of the return. This is just part of the return. So when you invest in the stock entitles you to earn dividends as well. Okay. Right. So so just like long-term debt, equity is also long-term. It has an infinite life. So you can hold on to the stock as long as the firm survives, as long as the firm exists. And typically, we assume that the firms will last forever, right? There's no expiration date. Okay, so we know we can, now we know we can raise long-term funds for the firm either by issuing long-term debt or by issuing long-term equity, right? Okay, good. So let's just quickly talk about some of the characteristics of equity. And then I'm going to ask you another question. Okay. So what's the main difference between debt and equity? Equity gives you the ownership right. Okay, if you buy equity, if you buy a stock of a firm, you become part owner of the company. Your ownership stake is proportional to the number of shares you own in the company. Okay, the greater the number of shares that you hold, the greater is your ownership in the firm. So it's proportionate, right? So if a company has hundreds, let's say 100 shares outstanding and you own 50, so it means you have 50% ownership of the firm. So if you do buy equity, it gives you the ownership of the firm, part ownership of the firm. We know that that's not the case if you buy long-term debt, right? Long-term debt doesn't give you any ownership right. And this is what I just mentioned. You earn a return in two ways. The first one is through price appreciation over time, as we have seen in the earlier example. So price change from one value to another value. The change in price is one way in which you make money, right? So that's what we call capital gains. Changes in price over time between 2 points, right? If you specify 2 points, right? The change in price is what we call capital gains or capital losses. Okay, and the other part of the return comes in the form of dividends. Dividends are paid only to stockholders, right? Those who buy the shares of a company. They're not paid to the debt holders. What do debt holders get? Interest, right? And interest is fixed. What about dividends? Are dividends fixed?
No.
No. Okay, why not?
Depends on the company's own discretion, their own decisions and the performance.
Okay, it depends upon management, right? How much the management decides how much of the earnings should be distributed as dividends, right? The dividends are not fixed. That's true. But what do you think is the pattern? So if a company pays a dividend, so to give you an example, let's say a company has a policy to pay 50% of its earnings as dividends, right? Then 1 year, let's say your earnings are 100, okay? And 50% of that is 50, so you'll give 50 as dividends, right? And what about the remaining 50? That's what the company retains, right? Okay, we call it retained earnings. So it's a part of the earnings that's retained by the firm, undistributed profit. Okay, it's still earning. So we call it retained earnings. So in let's say that in 1 year earnings were 100 and you paid 50 as dividends. In next year, we know that earnings are volatile, right? In next year, if earnings are 80, what would you do? how much dividends would you pay? In this case, 40?
I thought you said they had a management.
Yeah. That's right. I mean, yeah, I'm creating an example here to explain a point. So it could be 40, right?
Yes.
So that's what you would expect, right? The company would pay a dividend of 40. Is that right? Okay. Do you think you would pay, if you are a manager of this company, would you pay 40? This is what you should pay, right? Because that's based on the company's policy. That's what the management has agreed upon. But in practice, dividends are quite sticky. Companies are very, very reluctant to reduce dividends. They will only reduce dividends if there are exceptional circumstances or if there is a fundamental change in the way the firm operates, right? So normally, companies do not reduce dividends, even if their earnings have dropped in a particular year, right? So dividends are quite sticky. Why managers would be reluctant to reduce dividends?
Is it like a reflection of the company's performance? So if you reduce dividends, people might think as well, and maybe sell their stock, and if you reduce the dividend as well, they might go to different equity that have a higher dividend.
Very good, very good. So the argument is that it might reflect on companies' performance, right? Okay, but it's based on earnings, right? So why would you base it on dividends? You can say, okay, earnings is the main measure, right? If earnings that have dropped, so you would say, okay, now the firm is not earning enough, right? So should you consider something else? What was my original question? What did I ask you? Why managers are reluctant to reduce dividends, right? Okay, good.
Maybe it has to do with getting investor confidence, like they want to keep this in trust.
Okay, good. Good to give some sort of confidence. It's like, managing perception, right? Okay, anything else? I basically asked you, if you're a manager of a firm and your earnings have dropped from 100 to 80, what you would do, right?
So a performance index for the manager.
It reflects on managerial performance, absolutely, yes. Okay. So you would reduce the dividend, right? Okay. Okay, if you reduce the dividend. You want to say something? Okay, the question was why managers are reluctant to reduce dividend, right? Because there's a severe negative effect on stock price. So partly what both of you guys said, right? It reflects the investors may reassess about firms' earning potential. Okay, if the managers reduce dividend, that reflects the managers are not confident that in future they're going to increase, the earnings will increase. Also, another way to explain this is in terms of temporary earnings and permanent earnings, right? So the permanent earnings is what is where is the measure on which these dividends should be based on, right? So there's a permanent component of earnings, and then there's a transitory or exceptional earnings that can, fluctuate depending upon market conditions. And if you're in good years, your earnings will be higher than average. If there's an economic downturn, then your earnings will be negatively affected. But there's one permanent component of earnings, right, which is based on firm's core operations. So if managers decrease dividends, it reflects that managers are revising their earnings forecast downwards, right? So they are less confident about firm's ability to generate higher earnings in the future. So normally you would pay dividends, you would base dividends on the permanent part of your earnings, permanent component of your earnings, or your core earnings. Good. So they're reluctant to reduce dividends because there is a severe market reaction in response to dividend cuts. Okay, so stockholders have claim on all assets of the firm, and this is because they own the firm, right? Okay, it's because of their ownership right. They have claim on firm's assets. So as owners of the firm, they have a right to vote, and this is how they manage the firm. Because in public limited companies, ownership is so widespread, right? So it becomes practically impossible for one person or part owner of the firm to run the firm. Okay, so what they do is they hire professional managers, and if they are not happy with the way managers are running the firm, they can change firm management, right? So they have a right to vote. They have a right to vote on key issues, including the selection of top management. Okay, so that's how they run the firm indirectly. Okay. Managers are running it directly, but they can select who will be the managers. Right. Okay. Good. So now you know that there are two forms of long-term financing: equity and debt. Debt gives you no ownership right, but you have to pay fixed interest, right? Equity gives you ownership right, and then it's up to the management, right? Whether they want to pay dividends or whether they don't want to pay dividends, right? And it's completely it's management discretion, you know, whether they should pay dividends or not, or to what extent they should pay dividends, right? Okay, so if you are a manager of a firm, what would you prefer? Would you prefer to raise long-term financing through debt, or would you prefer to raise financing through equity? And you're thinking, right? Okay, so those of you who would raise long-term capital through debt. Very good. So those who would raise it through equity. Very good. Okay, nearly 50-50 split, right? Well, very good. Well done. Okay. So what you need to understand is basically the difference in terms of the two financing sources, right? And then you can decide what is appropriate for the firm given the circumstances. So one key feature of debt, as we already know, is that you have to pay a fixed interest, right? If you don't pay interest, what will happen? What will happen? You'll go bankrupt, right? You'll go bankrupt. So the firm will cease to exist. But what if you don't pay dividends? There will be a negative reaction, right? The value of your firm will go down. Okay. But it wouldn't force the firm into bankruptcy. Okay, so that's one major difference between the two. Okay, good. Right, so here we have a slight variation of equity. Okay, so we split equity into two different types: common equity and preferred equity. So common equity, it entitles you to the residual claim on firm's assets, right? So you guys remember the accounting equation, right? So what is equity? Equity is equal to assets minus liabilities, which means whatever of assets left after paying off or after settling your liabilities, that's what the equity holders will get. So that's a residual claim on firm's assets. Also, if you own a common equity, it gives you right to vote. So you can decide, who will run the firm, who will be on board of directors, what should be the main objective of the firm. Okay, and it also entitles you to a common dividend. Okay, good. So variation of this is preferred stock. Right. Okay, before we actually talk about preferred stock, another question that you should ask yourself is, if you're talking about raising long-term capital, and you know that you can use bonds or you can use equity, right? And you know that if you use bonds, you must pay interest. If you don't pay interest, you'll go bankrupt. If you don't pay dividends, there will be, downward revision in the stock price, but the company will still exist. Okay, so what do you think? Which of the two options is more risky? Debt is more risky or equity is more risky?
And that's more.
Okay, I'll give you some time to think. Okay, I'll give you 30 seconds to think.
So risky for the company or the person that.
Risky for the company or for the investors, right?
Yeah.
It makes no difference, right? It makes no difference. Okay. Risk is a risk, right? Okay. Okay. So 30 seconds. Good. Right, so okay, which one is more risky? Debt, that is more risky. Good. Very good. Equity is more risky. Good. Very good, okay. Equity is more risky, right? Equity is more risky. I know that those of you who said that, they must be thinking, okay, if you don't pay interest on time, you'll go bankrupt, right? Okay, but yeah, that's true, but that doesn't make the debt more risky, right? What makes equity more risky is because equity holders get paid at the end. Because equity holders have a residual claim on firm's assets. So if, for example, you hold debt, right? If you're investors in debt, right? And the company doesn't do well, right? You'll force the company into bankruptcy. What is the probability that debt holders will recover their money? Right, by selling the assets of the firm, right? When you force the company into bankruptcy, you sell the assets, there are cash flows, and debt holders will take their money back, right? So the probability that debt holders will get their money back is very high compared to equity holders, right? If the company goes bankrupt, they will only get whatever is left after paying everybody else. Okay, and there is a probability that nothing is left, right? So they'll lose everything. So equity is more risky compared to debt, yes.
So sorry, earlier I said for the investors or for the company, and you said they were the same thing,
Yes, it's the same thing.
but in your explanation, it's not.
In my explanation, it's not. Okay, good. That's fine.
Because for the investor,
Yeah.
Equity is more risky because they're the least after bonds are being paid. But for companies, bonds are riskier for them than equity because now they're forced into bankruptcy. Meanwhile, equity, the value of your company just plummets.
Right.
So it's on the opposite side, depending on who you're
Yeah.
reading it from.
Yeah, okay, I'll explain this a bit more. Okay, so the argument is, so she asked me earlier as well when I asked you guys this question, which one is more risky? So she asked me, it depends on whose perspective you're looking at it. If you're an investor, then your answer might be different than if you are a company, right? And I told you that it doesn't matter, right? Because there is this risk and return principle that we all talked about for so many weeks now, right? So what is this risk and return relationship? If a security is more risky, you would require a higher return for that, right? Okay, so we know the cost of debt is lower than cost of equity. And okay, how do you determine whether the security is more risky or less risky? You have to look at their claim on firm's assets. The higher, if they're entitled to get paid earlier, they're less risky, right? Because they're much more likely to recover their investments. If their claims come lower, right, if they are at the bottom, then the risk is much higher because the probability that they will not recover their money is much higher, right? So equity is more risky, and that is exactly why the required rate of return on equity is much higher compared to required rate of return on debt. Okay, so the other question regarding the survivability of the company, right? That's okay. Let's just think about it. If you don't pay dividends, right, you will not go bankrupt immediately, but the chances that you will survive in the long run are also low, right? Because your debt to equity ratios will go up substantially, right? So your debt remains fixed because it's a fixed claim, but as the price of the shares goes down, right, equity goes down. So the denominator goes down substantially, right, which inflates your debt to equity ratio.
So there are some companies that just don't pay dividend, like they're very little dividend.
Yeah.
So what about those companies?
Okay, good question. So we know that if you invest in equity, you're entitled to two parts. Your return comes in two forms, right? In the form of price appreciation, capital gains, or in the form of dividends. There are a lot of companies, not some companies, there are still a lot of companies that don't pay any dividend at all, right? So what does it mean? All of the return would be in the form of price capital gains, right? So even in the case that we have, right? In the example that we had, Google, right? We only calculated the change in price, right? We only looked at capital gains. And one of the reasons that we looked at capital gains alone is because Google doesn't pay any dividends, right? So the other question that I ask you is that you calculated the return to be around 26%. And I asked you whether this is appropriate return, right? So if the first thing you should do right now, because we have discussed that as well. So compare the return of this 26%, which is on equity, with the return on debt. Okay, so the cost of that is much lower compared to, the return that you're providing on equity. Okay. So the other thing that you might be thinking, I don't know whether you're thinking or not, but you should, which is that if a company pays no dividend, all of the return is in the form of price appreciation or price changes, right? So what if the company if the capital gain is not enough, right? So for example, in Google's case, we calculated it to be around 26% per year, but let's say if it's like 6%. Okay. So what would you do? What do you think? Okay. So, let me just ask this question slightly differently. So we calculated Google's annual return to be around 26%, right? And I think it's a really good return, right? So if you're investors in Google, all of you should be really happy, right? Every year you're making like 26%, okay? But what if I tell you that the return on Google was 6%? Would you be happy with this return? No? Yes, no? Yeah. You'll be happy, right? You'll be happy with 6%. What do you think? You? Yeah. Why not? Why not? Wait.
That's too low a return for
That's too low.
a residual claim on assets. I'm getting my money back if anything happens, I should be rewarded for the.
That's too low, right?
Yes.
That's your main argument,
Yeah.
right?
Yeah, that's what I'm saying.
That's too low.
It will probably be low compared to the industry like of the internet.
Right. Very good, okay? So if you only talk about return, right? You will never know what is the appropriate return, right? You must, right? You must talk about risk when you're talking about return. If you do not mention risk, there is no way you can tell whether the return is appropriate or not. Okay? So whenever you talk about return, you must include risk information. Okay, otherwise you can't compare. If, for example, I tell you that the Google is a risky company, okay? So on a risky company, you should expect to earn higher returns. In that case, 26% might not actually be good enough. If it's a really risky company, right? Okay, if I say Google is a very risky company compared to the average risk in the market, although 26% seems higher, but it has to be measured with respect to the risk. So if it's a very risky company, 26% might still not be sufficient, given the risk of the company. Okay? Given the risk of the company, it might still not be sufficient. On the contrary, I can also say if it's a least risky company, right? It has very low risk. So given the risk, even if 6% in that case might actually be better, right? So comparing returns in absolute terms without taking into account the risk will lead you to wrong conclusions.
Just a question on, when you're when you're a manager and you try to decide, should you issue on debt or more equity? The manager choose to issue more debt because it is tax deductible.
Good, very good. Okay, so that's one, okay. That's one of the advantages of using that, because that provides you tax shield, right? If you use debt as a manager, right, in your company, you have to pay interest, right? And interest is treated as an expense, right? So which means your income will go down, right? And how do you get income? Your revenues minus expenses. And in expenses, you've included interest as well, which means your income will go down further, right? So on lower income, you'll pay lower tax, right? That's one of the advantages of using debt. But yeah, so the idea basically is that there are differences between equity and debt. There are advantages of that, and there are drawbacks of using that. There are advantages of using equity, and there are disadvantages of using it. So you, being a manager, would need to understand these differences, right? And then make a choice given the circumstances. Okay, yeah.
Does this tax benefit come even when I'm not paying the debt this year?
Sorry.
So like the tax benefit, like let's say, I don't have to pay taxes on my debt. Is it debt that is maturing that's given tax year, or any debt on my balance sheet is tax deductible?
Okay, you raised a very good point earlier, but now your scroll kind of messed it up. You don't pay, there's no, the advantage of that is through tax shield. Now you're talking about debt, whether debt is maturing or not maturing, that's immaterial. The tax shield benefit is only on the interest component of it, not the principal, right? Okay. Good. All right, good, very good. Anything else? Yeah. Good. Okay. So now we know that there's debt. We know there is common equity. And then we have a variation in common equity, which we call the preferred equity. Okay? The preferred equity has characteristics of both debt and equity. So you can think of preferred equity as a hybrid security, right? So if you look at the characteristics of preferred stock, so they get a priority claim on firm's assets as compared to common equity. So their claim comes first compared to common equity holders. Okay. So what do you think about the risk? Is this more risk, preferred stock is more risky or common equity is more risky? Common equity, right? Okay, because now how would the accounting equation look like? Common equity is equal to assets minus liabilities minus preferred equity, right? Okay, so the preferred equity holders will get paid first, then common equity holders. So preferred equity is less risky compared to common equity. Okay, it entitles you to dividends, right? But the difference here is it entitles you to fixed dividends. Okay, so which is a characteristic of debt. Debt entitles you to interest, fixed interest, right? So it's just like on debt, you have predetermined what is the interest rate, and that will determine your interest payment. Similarly, on preferred equity, depending upon how much money you have raised to preferred equity, you determine a dividend rate, preferred dividend rate. So it entitles you to fixed payments, just like that. Okay, so it's similar to that because it gives you guaranteed payments at regular intervals of time, right? Yeah, good, very good. So the question is, if the company made a loss, the company would still have to pay for dividend. Okay, good. And the difference from equity, common equity, is that the preferred stockholders are not entitled to voting rights. Okay, they're still equity, but they don't get any voting rights because they do not bear all of the risk, right? Common equity holders will bear the risk. Okay, good. So here is an example of how a common stock look like, right? So that's just a piece of paper that entitles your proportionate ownership in the firm. Okay. So I already asked this question, how would you raise capital, firm, debt, or equity? We have looked at the differences and characteristics of debt and equity. And one of the things that you mentioned is whether if the company does not make any earnings, does it still need to pay dividends? And I told you preferred dividends, it still needs to pay preferred dividends. Later on, I have another slide on it, but since we are discussing it, so I'll mention it here. So normally there's a provision, so preferred stock comes with this provision that these dividends are cumulative in nature, right? So which means even in a particular year, the company has no earnings and it's unable to pay preferred dividend, right? But in later years, if the company makes earnings, so not only dividends, preferred dividends of that year should be paid, but preferred dividends of the previous year should also be paid, right? So they keep on accumulating. It's not that the company can forego this if there is no earning, right? Whereas for common equity holders, if there is no earnings, they get nothing, right? But that's not the case with preferred stockholders. So that is why preferred stock is less risky compared to equity. But what do you think about, is this preferred stock more risky or less risky than debt? More risky, right? Because their claim comes after paying off the liabilities. So interest gets paid first, right? Interest gets paid first. And if there is any earning left, any income left, then you pay preferred dividends. Okay. Any other thing that you can think of in terms of differences between debt and preferred stock?
Don't get your principal back.
You don't get, you get your principal back, right? In that,
But not in a preferred stock.
not in preferred stocks.
Unless you sold it in the secondary market.
Yes. Okay,
So
good.
you can't guarantee the same principal as you put in.
Uh, The preferred stock, they come with a fixed value, right? Just like that. So they have a face value on which and rate on which you calculate the preferred dividends, right? Yeah, any other difference?
During bankruptcy, people would get paid back.
Sure, we discussed that already.
Which rate is higher?
Right.
Which rate is higher?
Which rate is higher?
Yeah, for
You tell me. Which rate is higher? Which rate should be higher? Huh? Oh, right. So you know the answer. What are you asking this question? Common equity is more risky, so the required rate of return on common equity should be higher. Any other difference between the two? Okay, think about from the perspective of a firm. If you are a manager of a firm, which one would you prefer? Debt or a preferred stock? The one key advantage of that, which we already discussed, is its tax deductibility. Interest is tax deductible, so it provides you some savings in the form of tax shield. Whereas preferred dividends are not tax deductible. Okay, so that's a drawback of using preferred dividends. Okay, it provides no tax shield. So how would you finance a firm, debt or equity? You're not taking corporate finance this time, right? Okay. So, but some of you who have already taken corporate finance, they would know that there is a pecking order. So there is a pecking order theory that determines, which method or which form of long-term financing you would use and in which order. So this is based on pecking order theory. What I say is that managers would prefer to use internally generated funds. What's internally generated funds? The firm is operating, it's generating cash flows, right? It's generating more cash flows than what it's paying out, right? If cash inflows are higher than cash outflows. In other words, you can also, so for simplicity, there's a difference between cash flows and earnings or profits, right? But for simplicity, if you assume that the two move together, so this is basically earnings that the company is retaining. If the company is generating earnings, it's profitable firm, right? Its expenses are lower. So every year, the firm will retain a portion of the earnings as retained earnings. So these are the funds that are available to the business, right? Because these are retained by the business, right? So this internally generated funding, internally generated financing is what the managers would prefer. So if they need financing for investment purposes, they will first go and dig into the pool of the savings that they have, right? Okay, if they still need more funding, right? If they still need more funding, if internal funding is not sufficient, then they'll go to the debt market. Okay. And if they can't raise sufficient financing through debt, only then they will go to equity market. Okay, so this is what we call a pecking order theory of capital structure. What is capital structure?
Source of financing.
Good, very good. Okay, so capital structure is a proportion of debt and equity financing. Okay. Good, all right. So we covered all of this, right? So I have this slide, yes.
The difference between internal promotion and equity promotion. Both are the owners of the business generating.
Good, very good question, right? Very good question. Okay, so the question is, what's the difference between equity and internally generated funds, right? Anyone know the answer? Okay. Okay, let me add a bit to it and then you can probably try it, okay? So, okay, it's a very good question, right? The internally generated funds versus common equity, right? What's the difference, okay? So, to give you a hint to answer this question, you have to think about the riskiness. Okay? What's, okay, so we know what is the required rate of return on equity, right? What about the required rate of return on internally generated funds? Will it be higher, lower, or anything else? I'll give you time to think about this, right? Okay, so you all understand the question, right? What is the required rate of return on internally generated funds? Okay, if the required rate of return on internally generated fund is higher, right, then you would know that it is more risky, right? Okay, if it's lower, then you would know it's less risky compared to common equity. Right? Okay, good. Right, so internal generated required rate of return on internal generated fund is higher than common equity. No more. Okay, lower than common equity. Yeah, higher, right? Good. Right. Higher, lower? Why didn't you raise your hand? This. Anyone who thinks it's different? Yeah, go on.
I believe it's equal.
It's the same, right? The required rate of return on internally generated funds is the same as the required rate of return on equity, right? Why? Because these are essentially equity holders' funds, which are not given back to them, but the company decided to keep them. So the required rate of return, so what is this retained earnings, right? These are earnings that belong to common equity holders, but the company decided to keep it within the firm for further investments, right? So it's essentially those shareholders have provided this additional funding. Okay, so the required rate of return on internally generated funding should be exactly the same as the required rate of return on common equity, because these are essentially common funds provided by common equity holders. Why the risks are different?
Because internally generated funds come here in the hierarchy of peak also, and logically, if we see, we are not supposed to give any kind of return to anyone because those earnings belong solely to the company and it does not have to pay any interest or any dividend on such earnings. However, the cost is just the opportunity cost of investing those earnings rather than.
Right. Okay, so the first argument is actually incorrect, that there have differences in risk. There are no differences in risk, okay? So okay, so think about this, right? So let us do some sort of reverse engineering, right? So let's say I'm a firm, right? And you have invested in my common stock, right? Okay, so I make some earnings. All of these earnings belong to you guys, right? So let's say your required rate of return is 15%, for example. Okay. So you've determined, given the risk of this firm, you require 15%. So whatever I have generated, that belongs to you. I can do two things with that. I can return all of that to you, or I can keep all of that with myself. Okay? So if I return, okay, let's start with this. If I keep all of it with myself, the reason I will keep it with myself is because I need it for further investments, right? Okay, so it's essentially your funds. I'm using your funds for further investments with the same risky, the assumption is the further investments have the same riskiness. Okay, so that's one way I could do it. So it means any investments that I make, you will require the same return on these, right? The other way I could do it, I can give all of it to you, right? So I have nothing now, right? And now I need funds. So for this, what would I need to do? I need to go back to you and say, okay, look, I need investment. So will you give me funds, more funds? So you give me all the funds that I've given you, right? You'll give it back to me. My riskiness doesn't change, right? So the required rate of return or additional funding that you'll provide me will still be the same. So it's exactly the same thing. It's just the way you collect the funds. You keep it or you raise it further, okay?
Company does that, it gets.
There are
penalized.
additional costs, right?
Yeah, and also it gets penalized in the market, you said, then when the dividend is revised, maybe downward.
So if there is a downward revision, then it will get penalized for sure, right? But here we're not talking about downward, we're keeping everything else constant, right? We're only talking about how to raise the fund. Internal generated or raising additional capital. Given that the risk of the company doesn't change, the required rate of return would be same. Okay, because the internally generated funds are essentially your funds, right? It's just that I haven't given it back to you and asked you to give it back, right? It saves cost basically, right? Good. So the riskiness is what will determine the required rate of return, right? So internal generated funds are basically shareholders' funds, not returned to them, right? Okay, so the required rate of return on these funds will be exactly the same as the required rate of return on common equity. Good, very good. Okay. Good. Okay. So from a manager's perspective, going to the market to raise additional equity is their least favorite, right? Okay, so pecking order theory is just one theory of capital structure. There are other theories of capital structure as well, but this is what's relevant to this session. Okay, good. So we know equity has advantages. There are no repayments required, right? No extra burden is borne. Increasing equity does not increase the risk of bankruptcy, right? It doesn't increase the risk of bankruptcy, right? But there might be other costs associated. And it doesn't require monthly or annual or semi-annual payments. There are no fixed commitments unlike debt. And one advantage of equity is that risk is shared between shareholders. So it's not one person's wealth that is at stake, right? So if you all hold some portion of the firm, so you're basically sharing that risk among yourself. So the risk of the company is shared between shareholders. Okay. And one key advantage of equity financing is that you can raise huge amounts of funds, right? Because the market is big, right? Everybody is the potential buyer of your stock. So the market is big. You can raise huge sums of money by issuing equity. Okay, so when you raise equity, you can raise it privately or you can raise it through public financing. Okay, so private firms are ones that will invest in equity of the firm, which means they will assume the same risks as they're investing in equity. But the number of people involved in that would be limited. So there are angel investors who would invest in startups, right? So these are few individuals with, high net wealth, and they can, pick new startups that they believe have potential. Similarly, there are venture capitalists who invest in startups as well. So they invest in new companies that they believe have potential. Have you guys seen Dragon's Den, right? So that's essentially kind of a venture capitalist idea, right? So there are a few individuals which have lots of money. They look at different projects that are presented to them, and they, decide, which project do they like and whether they want to put some money, invest in that project or not. And then we have initial public offerings. So this is the first time when the companies issues shares to public. And then we have these public firms. We can raise equity through these public firms. So seasoned equity offerings, we'll talk. We'll look at the difference between IPO and seasoned equity offerings later on as well. So these are shares issued, additional shares issued by a company whose shares are already trading in the stock market. Okay, private placements is that, you identify potential investors, but these are generally bigger investors. These could be investment banks or other financial institutions. And instead of issuing it to everybody, you just ask few bigger investors to invest in your firm. And then there are rights issues. What are rights issues? No?
Existing shareholders have the right to buy additional shares of the company.
Very good. So rights issues are essentially secondary equity offerings, but these are offered to existing shareholders. So existing shareholders are given the first right to buy additional shares. Okay, so you're issuing more shares to your existing shareholders. Okay, good. Right. Okay, so private equity. So it's a business that is privately held, and the owners cannot typically sell their shares to public. So some business owners may want to go public to cash out, right? So if they can, if they can obtain financing to support their growth, and they can also go public if they want to cash out, right? If they want to withdraw their money, right, from the firm, they can go public and then sell their shares in the secondary market. A public offering is feasible at larger scales. So the owner may go for public offerings if they want to raise at least $50 million or more. And they can raise these large amounts because we know that the shareholder base is actually quite large. And this is especially true if there is an active secondary market, right? Because active secondary market provides liquidity, right? So you think about comparing markets across countries, right? So the liquidity may vary across countries, right? So for example, in US, which has the highest or the most liquid secondary markets. So developed countries typically have more liquid secondary markets compared to developing markets or emerging markets, because the shareholder base is not that wide. Okay. Right. So venture capital firms. So this is through. So you can raise financing through these venture capital funds. So what is this venture capital fund? So they receive money from other wealthy individuals, right? They can include funds from other financial institutions as well, such as pension funds, and they're willing to maintain the investment for the medium to long term in the project that they invest. Okay, so investors are not allowed to withdraw their money before a specified or specific deadline. Okay, so this is medium to long-term investment commitment. If you invest, if the financing is raised from a venture capitalist. Okay, so how, yeah.
Is it a bit shocking that the pension fund would take on a risky investment with VC just capitalists?
Say that again.
Sorry, so venture capital and venture capital investment is naturally very risky.
Is naturally very risky, yes.
So the question here is, why would a pension fund take on such a huge risk?
Good. Okay, good question. Okay, so the question is, if you are a venture capitalist or if a venture capital firm and you're investing in startups, right? If you're investing in startups, then you're assuming higher risk, right? That's true, right? The second part of the question is, these venture capitalists, capital funds or firms can also have funds from pension funds, which are less, which are risk averse to some extent, right? Okay. But these pension funds are huge, right? They're not putting all of their capital in these venture capitalist firms, right? They're putting a small portion, very small portion. Okay. And so if you look at the portfolio of pension funds, the risky investment is a very small part, right? So as a portfolio, they're still less risky. Okay. And the reason they want to invest in through these venture capital funds is that so that they can capitalize on higher growth rates, on higher returns, right? So they're not putting all of their pension fund in risk by putting all of their money into these startups. It's only a small fraction. Okay. And the reason is to benefit from higher expected returns. Good question. Okay. Good. So venture capital capitalists, what they do is they look at proposals. So they organize these venture capital conferences where new startups come in. They pitch their idea, what the company is, what their plan is, and then they decide on which projects that they're going to fund. So in the terms of venture capitalists are determined when they agree to invest in a particular project, and these are negotiated between the two parties. So they can vary from deal to deal, right? It's not like a standard set. Okay, so the venture capital fund will set out requirements for the business, and the fund managers may serve as advisors to the business. So that's one of the characteristics of raising financing through these venture capitals, is that not only they're getting some funding, but they're also getting some sort of advisor as well, right? So venture capitalists are more involved in the projects that they take up. So they're buying into the experience of venture capitalists as well. Okay, so how do these venture capitalists exit? So funds typically plan to exit in 4 to 7 years by selling their equity once the firm goes public, right? So if the startup is a successful one, it scales up. As a venture capitalist, their funds are tied into the firm, right? Okay, if the startup turns out to be good, it's growing, they can, go for an IPO and then they can cash out. Performance of venture capital funds varies over time. We know that funds can be invested more wisely when the stock prices are low. That's we all know. But what they are good at is that they are able to better value the firms than an average investor. So it also gets influenced by the amount of investment received by investors. Okay, so venture capitalists get a lot of investment, right? Then so if I'll save this for the next I'll save this point for the next scenario. Okay, so private equity fund. So just like venture capitalists, there are private equity funds as well. So it's a pool of money provided by institutional investors, right? That's the main difference. So in venture capitalists, these are wealthy individuals who pool their money together, but in private equity, they get funds from institutional investors as well. And one of the strategies that they use is that they use a lot of debt. Okay, so that's what we call high financial leverage strategy. So they rely heavily on debt to finance their investments. So the strategy of private equity funds is as follows. They identify and invest in undervalued firms or firms that are mismanaged. Both of these basically mean that the stock or the firm is selling below its real value, right? So they identify such firms and they invest in these. And as I said, these use debt to lever up. So for example, if you know that the firm is underperforming and you can transform it, right? So should you put more equity or should you put more debt? I'm going to repeat the question. So let's say here we have a firm A, right? And we know that it's undervalued, right? So let's say you know that the stock is undervalued, so you can buy it now. And then you know why it's undervalued, so you can do the improvements. And once you do the improvements, the value of the stock will go up, right? Okay. So what would you prefer? So in order to buy this firm, undervalued firm, would you like to put your own money or would you like to use a lot more debt to buy the firm? You would use debt. Why?
It's risky and Elon Musk.
Okay. Okay, anyone else?
I would use equity because then if you're saying it's undervalued and we know how to increase the value, then you'll benefit from capital gains.
Very good, thank you. Equity. Anyone else? Okay, let's make it more interesting, right? So let's say we have a company, right? Let's say we have a private equity firm, right? And means that this three individuals are partners with the firm, right? Okay. Good. So we buy the firm, we'll improve it, and then we'll sell it, right? That's how we make money, right? Okay. You're with it? Good. Okay, so we identify a firm, right? So we can put all of our monies together. Okay. And then improve and sell. The other way is that instead of putting all of our money in this one firm, we can, you know, reduce our exposure to this firm, right? So let's say we'll put 25% equity and 75% debt, or like, let's say 50-50% was, right? 50% equity and 50% debt, right? Okay. And then we have 50% equity saved, which we can invest somewhere else, right? That's one advantage, right? You're diversifying, right? But the real reason that you will use debt is because that is a fixed claim. Okay, so let's say the value of the firm is 100. After improving, the value goes to 200, right? And because equity holders get the residual claim, debt holders are entitled to the same amount, right? Okay, if the debt is 50, you'll pay 50, right? It doesn't matter whether the value increases from 100 to 200 or 100 to 110. They're still entitled to 50, right? So you will end up making a lot more if the value of the firm goes up, because all of the residual earnings, all of the residual increase in value belongs to you. Okay, so debt holders still get whatever they invested in. Okay, if the increase in value is large, you would want to use debt. Okay, because you will simply repay whatever you borrow. You will not have to share the gains with anybody else. Okay, does it make sense? Good. Right, okay, good. So they can improve performance, and then they achieve high returns, and then they sell their stake in the business after several years, sometime by taking the firm to sometimes after an IPO, once the performance has improved. Right, so their exit strategy is similar to venture capitalist firms, right? So they take the firm, either they sell the firm to someone else, or they can take the firm public, so they can list it and then sell their shares in the secondary market, or they can sell it to another business or another company. So performance of private equity funds. So again, similar to venture capitalists, it tends to vary over time. Funds can be invested more wisely, which we know, when stock prices are low. So you invest in those times. Right. And then something that I skipped in the previous slide about venture capitalists. So this is the risk, basically, of investing through private equity funds. So these are prone to poor investments as well, especially when the firm has huge amount of funds available. So if we are 4 individuals and we have a lot of money to invest, right, then there is no point sitting on that money, right? So we'll make lots of investments. And if we make lots of investment, then each investment gets little time, right? So our attention gets diverted. At the same time, some of those investments will turn out to be good, some of them will be bad, right? So when the firm has huge amounts of funds, they are prone to making poor investment choices as well. Okay. Good. So another way to raise funding is through crowdfunding, which quite a lot of you might be familiar with. So this has gained a lot of popularity in recent times. So it's just like raising funding from individuals, but over the internet. And individuals do not put in huge sums, right? They make small contributions, small investments. So it's funding raised from general public over the internet. So at the bottom, I have listed a few examples as well. Okay, so let's take a quick 5-minute break. Okay, no? Okay, all right. Okay, 10 minutes. Okay, 10 minutes.